Right, okay. Good morning, good afternoon, and good evening to everyone. Welcome back to the latest latest episode of the Trading Vault. So, as always, please let us know where you're calling in from, where you're dialing in from, where you're coming in from. Say hello, let us know your sort of level of experience as well. And then, as always, towards the end of the call or towards the end of the webinar, if you could stay on and fill out a short survey for us, it would really help us tailor these ongoing webinars to make sure we get you the information and the content that you will find most valuable. So, good morning, a lot of people. So Scotland, we've got UK, Malaysia, Canada, Holland, UK again, Dubai, great stuff. So again, a great mix from all across the world. So yeah, UK, Malaysia, India, Hong Kong. I know it well. Mikhail out there, love Hong Kong, Philippines, Zimbabwe. Okay, Ghana. So some from Africa as well this morning. Okay, right. So today, if we could also just do a quick visual check. Obviously, you guys can hear me, but a quick visual check to make sure you can see my screen as well. That would be great. You should see a screen which says a Trading Vault Mastering Reversal Trading to Profit from Market Turning Points. So if you can just, if somebody can just confirm they can see my screen, okay, that would be great. Perfect. Thank you very much, guys. Okay, right. So in the last episode, we spoke about trend trading and trading with momentum. So hopefully, those of you that was in that session, you found that useful. You got the strategies, and hopefully you've been putting that into practice as well. And hopefully that's been a benefit for you. But we want to talk today about reversal trading. And obviously, we spoke in the impulsive and corrective session about trying to identify when we're moving from a trend trading or impulsive move into that corrective phase. So when you're in that impulsive move, you want to be looking for those, the trend trading strategies that we spoke about in the last session. And when we're moving into that corrective phase, we want to be really looking at these sorts of strategies, these reversal strategies. Now, another quick question for all of you guys. If you've been trading for any length of time, I'm sure that you've heard of what are known as market traps, stop hunting, or what I refer to as liquidity grabs. And this is where the market and the institutions move the market into areas. You get stopped out as a retail trader only for the market to reverse quickly and go in the direction that you want. Now, people sit there and call it market manipulation. They fall victim, like they have an ideology that they fall victim to this sort of thing, this sort of theory. But today I'm going to sort of tell you why it happens, and also hopefully switch the mindset and show you some strategies that, rather than falling victim to this sort of this market behavior, which does happen, then we can actually profit from it rather than. So there's some characteristics that we can look for, and we can actually identify when this happened, and then we can actually profit from this sort of like this phenomenon that happens in the market. So as always, please do feel free to ask questions throughout the webinar. Any ones that that are relevant, we will answer there, but we will try to keep the webinar going, and we'll do a Q&A at the end as well. If I do miss any, as always, I do apologize. It won't be intentional, but if I have missed any as we go through, then please do feel free to ask the question again at the end, if I haven't already answered the question through the presentation. Okay, so with that being said, let's get on with the presentation. Now, again, just a quick introduction to me. I know most of you, or many of you, have been coming to these webinars, but just a quick introduction to who I am. I am VT Markets Global Operations Strategy Lead. I provide high-level educational content for traders of all levels, from beginners right the way through to experts and professionals who want to improve themselves. I am a professional trader myself, and I'm also an investment manager. I've been trading for more than 20 years with a career that started in London and then went to Hong Kong. And now for the last sort of decade, or more than a decade now, I've been an independent trader. I'm an award-winning trading coach and mentor, and founder of an online trading education company called Key Zone Traders. So that's just a quick introduction to me. And now we're going to get on to the main bulk of the presentation, which is about reversal trading. So trading in corrective phases. So if we identify that we are moving into a corrective phase, then we need to adjust our strategy and approach to the market to reflect this. And we covered this in that impulsive corrective session that we did. So I'm not going to go into huge amounts of detail about this now, but we can watch the previous session on replay. But we don't want to try and force trades to hit big targets when we are not in a phase of the market that will reward this. And what I mean by that is, you know, in a corrective phase, the moves are going to be more choppy. They're going to be smaller. So we don't want to go for big reward trades when we're in a corrective phase. We want to go for big reward trades when we're in that trending market and the market is being expansive and moving further. So we need to exercise more patience and discipline in waiting for our trade setups when we're trading in corrective phases of the market. And it's vitally important that we identify the right areas of the market to trade, because, and this is one really key point on a corrective phase. Just because we are in a corrective phase doesn't mean to say that we necessarily need to trade it. We only want to be trading corrective phases where there is clear support or resistance, clear defined levels to be able to execute our trades from. If there's not clearly defined levels, it's going to be very choppy. It's going to be very difficult to trade from, and therefore we're not going to get very many good setups. So just because we're entering a corrective phase doesn't mean to say we have to be trading. We want to wait for the structure to develop, and then we want to make sure that the structure is clean, and then we look to execute our trades. So just a quick recap of what a corrective move is. We can use the information from the impulsive and corrective session to identify when when the market is moving into a corrective phase. So the characteristics of a corrective move are: the candlesticks are a mix of both bullish and bearish candles. There will be a lot of wicks on show on both sides of the candles, and lots of indecision within those candles. So lots of what we call doji bars and stuff like that as well. Generally be smaller and more of the average size of the candle, whereas in an impulsive move, they're much larger. Candles will often overlap, and price will oscillate back and forth above and below the EMAs, which, as anyone who's been in the other sessions know, I generally use the 8 and the 20. And also one really key point, one easily visual point that you can use is the EMAs are horizontal and will cross over regularly. And we'll just go through, just show you a quick example of what I mean here. This is a corrective phase. You can see these moving averages are very much pretty horizontal. They're crossing over, they're overlapping quite regularly. You've got a good mix of bullish and bearish candles, lots of overlap. You can see lots of wicks on show here. And also one other tip that I forgot to mention on that previous slide, which I mentioned in the original session. If you draw a box around the high to the low and the width of the move, it will generally be rectangular and horizontal in shape. So you can see this is like a horizontal rectangle, and that generally shows that we're in a corrective phase of the market. So that's just a quick recap on what a corrective phase is. But I want to talk about these liquidity grabs. As I say, they're sometimes known as market traps, or they're market traps or market manipulation or stop hunting, but I generally call them liquidity grabs, and I will refer to them as liquidity grabs as we go through this presentation. So to understand why they happen, you have to understand the primary function of the market. The primary function of the primary function of the market is to enable trade by connecting buyers and sellers, ensuring the most efficient matching between them. So if you think of any marketplace, not just the financial markets, even like a fruit and veg store, it's to supply the product and match and sell as many of the product as you can to the people that want to buy it. So it's matching buyers and sellers. That is the primary function of any market. So the market will therefore gravitate to where there is liquidity, where it can facilitate trade. That's the same in the financial markets. The market will often move into areas that are likely to have obvious stop placements, that stop hunting element of it, or likely to have resting orders for traders looking for breakouts. Now, the reason that it looks for those areas is because it will trigger traders into or stop them out of trades, creating liquidity and fulfilling its primary function. So what happens if you're in a trade and the market moves into that area and you get stopped out? What is your next action as a trader? You're looking for another trade opportunity. So not only does it facilitate the trade to stop you out, it then also makes you look for another opportunity to get in. And likewise, if you're if you're triggered into a breakout trade, you're going to have a stop in place, which is going to come back and it's going to trigger that stop. So it's creating all of this liquidity, which is its primary function of a market, is to create that and facilitate that trade. So hopefully you can understand that all that's really happening is the market is performing its duty to match buyers and sellers. It's not personal. It's not against any one individual trader. You know, it's not manipulating the market. It is just performing its primary function as a market. Okay, so this is why stops and entries in obvious places often get triggered only for the market to reverse and cause that frustration to a trader. And it's what, as I say, it's market trap, stop hunting. But as I say, I will refer to it as a liquidity grab. I always refer to it as a that's what I call a liquidity grab, and I'll refer to it as a liquidity grab in this presentation. Now, many traders often feel the market is rigged against them when this happens repeatedly. But by knowing that it happens repeatedly, we can use this to our advantage to create successful trade setups. Okay, so these happen on all time frames and on any instrument and asset class. Okay, they occur mainly in range-bound markets and when the market is in a corrective phase, rather than in trending markets when the price action is much cleaner. Because in trending markets, you are going to get much cleaner breakouts. You're going to get much truer breakouts because there is one real dominant side of the market. Whereas in a corrective phase, it's much easier for the market to move and manipulate against or to go against the buyers and sellers and control that order flow. So we want to look for clear swing highs and lows to be formed, or for clear areas of support and resistance to be established, and identify obvious areas where stops are placed. Look for the market to enter these areas and reverse quickly. This is really important. It's got to reverse quickly. Only once you see this price action should you be looking to enter the trade. So rather than being in the trade and then getting stopped out, what you do is you watch the markets, you identify areas where there's going to be obvious stops, and then you set your alerts. So once the market moves into that area, you then look for your trade setup. You look for that move into the liquidity area, the instant reversal, and then you can look to get in and actually profit from the trade. Okay, so just going to show you what this looks like. As I say, this happens on all time frames, all asset classes. I trade this on sort of 1 hour charts, Forex, indices, oil, gold, but it's a market function that happens across all markets. And one of the ones that I really like to use is this. This is a monthly Bitcoin chart. And I always use this example to show liquidity grabs because I think it illustrates it really well. Now, you saw in this goes back to the Bitcoin correction back in sort of the in 21, 22. And you can see here that Bitcoin made a high around 64,850. Okay. And then it sold off quite sharply. Now, there was a lot of furor, a lot of people talking. I had a lot of friends talking to me about, you know, the next leg up and it's going to break out. It's going to like 100,000, 250,000. But I remember talking to people at the time and sitting there saying, no, this is setting up a classic liquidity grab. And I think the market's going to come off. Now, anyone who shorted the market in this area would have their stops in this place. But most importantly, there were a lot of people at the time looking for the breakout. So they would have had resting orders waiting to catch that next leg up to break out. Okay, so what did the market do? You can see the market came up and it quickly reversed. Okay, I mean, this was over the course of probably 4 to 6 weeks, but in terms of the monthly chart, that is a short time. That is one candlestick quickly closed back down with a negative candle inside the liquidity, back inside the liquidity, and therefore sold off. So it moved up, grabbed the liquidity that it needed, big wick, rejected it, and then sold off. So it wanted to go and facilitate that trade. It knew, the market almost knew that there was going to be stops there, there'd be resting orders there, and it wanted to take that liquidity before doing the thing that it was going to do anyway. So that's a really good example. And again, it shows that it's any time frame because this is a monthly Bitcoin chart. Personally, I don't even trade crypto that much, but it shows that this is like a phenomenon that works on all asset classes, all time frames. So you can look for this on all time frames. Okay. Cool, no questions as yet, which is great. Let's go and start moving on to what we're looking at. Now we're going to look at identifying false breaks. And this is effectively, this is in essence a liquidity grab. It's pretty much the same thing. Last time we spoke about the characteristics of a pre-breakout structure and what that looks like to understand when we are more likely to be seeing a true breakout. But this time we want to talk about identifying that false break, identifying that liquidity grab, so that we can profit from it. So it's a move that traps traders on the wrong side of the market. And we therefore should again be looking for clean areas of support or resistance, or clear swing highs and lows, to be looking for the areas that we want to be looking to trade false breaks. And a reminder, for a true breakout retest, we want to see an impulsive breakout followed by a corrective retracement to the zone of support or resistance. So you see the breakout be impulsive and very quick and sharp, but then the retracement is corrective. That is for a true breakout. The characteristics of a false break are slightly different. So we want to see price breakout cleanly above that zone of resistance or below a zone of support. But to identify the false break, we want to see price reverse quickly and reject that area. So the difference is that false breaks will reject the area, will reverse quickly, whereas in a true breakout is going to be more, the pullback is going to be more corrective. So it moves impulsively back below the broken zone of resistance, or impulsively back above the broken zone of support. And price must close, this is important as well, price must close back inside the zone of support or resistance. If you see this impulsive pushback down below the support, but then it actually pushes back up and closes above so if we see a zone of support, it pushes down and it impulsively pushes back up above the zone of support, but in the same candle it pushes back below the zone of support. It's showing that the buyers aren't in control, and actually the market is a bit more comfortable below that level, and it's just a bit more choppy around that zone at the moment. So it's really vitally important characteristic that the market closes back inside that zone of support, or vice versa, the zone of resistance, if it's breaking out from higher. Yes, Paul, I'll be showing examples of these shortly, and I'm also going to go through some mechanics of a strategy that you can use to take advantage and look for on this as well. So as I say, this what happens by it closing back inside is it's telling us that the market has taken the liquidity, it's performed the function of the market that is necessary for it to do its job, but it's not comfortable there and trading in those areas. So it's just going to get on with it and get back inside where it feels comfortable, where it feels the price is comfortable, and where it sees price as value at that time. So as I say, it's important that it moves back because it shows it's uncomfortable in that area. If it starts moving back below, it shows that actually it might be comfortable in that area, and maybe the liquidity is just dried up in that area and it's a bit more choppy and a bit more unclean, in which case we don't want to be trading those sorts of setups in those areas at that time. Okay, just checking to see if there's any questions. You can trade with trend lines, Sideway. Personally, I use, if you was in my support and resistance session, I use more horizontal zones. I find trend lines can be a little bit more subjective. So there's a little bit more ambiguity around it, but certainly they would work with clear, and again, I think this is the most important thing, is if you have a clear and defined trend line, then I think it's okay, and it will work with those as well. I could show you examples. We're not showing examples in today's session, but I could certainly look for and show you examples of trend line false breaks as well, as much as anything else. So it does work with trend lines. I think you just need to be careful and make sure you're trading really clean, clearly defined trend lines. Okay, so some other tips on how to identify the best setups. If we see corrective price action on the other side of the zone, then we should avoid trading that area as price is no longer respecting that zone. If price action is corrective on the rejection after the initial break, then we may just be seeing a deeper retracement in an unclean trend. So again, we want to see that really decisive move back below. If it's just corrective, you're looking for that true breakout. But If it carries on going back below the zone and it remains corrective, we may just be seeing a deeper retracement. Okay, so we want to see a clean break and an impulsive move back below. Once prices close back inside the zone of support or resistance, it can often retest that area and confirm it as support or resistance again. And again, I'm going to show you this in an example in a moment. For day traders, so if you trade, and especially this is on indices, so if you trade things like the DAX, the FTSE, the Nikkei, the S&P, the NASDAQ, it often happens for, around overnight ranges or previous day ranges, like overnight highs, lows, previous days highs, lows. The market often likes moving into those areas and reversing quite quickly. So that you can take advantage. That's really only on sort of like for day traders on sort of like 15-minute charts and below. But you can see that certainly on indices as something to look out for, especially. Okay, a couple of questions. Yeah, I'm going to show an example of a false break in a moment, Andrew. From a newbie like myself who struggles to identify support and resistance zones, where can we look at get guidance on determining these? So Gavin, we have already covered a session on support and resistance. So you can hopefully look at the replay and the recording of that to get a better understanding of how to plot support and resistance. I'm not sure whether support can post a link for the replays for Gavin, but if not, contact your account manager. I'm sure we can get you a replay of that one. Okay, so example. We've got a clear established zone of resistance here. This was on a GBP US dollar 4-hour chart, okay? We had a clearly established zone of resistance. You can see the market came and tested it again, pushed back, and again, rather than just rejecting that zone straight away, what does it do? It goes up. Notice that it closes just above the zone, moves higher. So again, there's some people who would trade a breakout where they get to close above the zone and then they enter on the break of that. So again, it traps those traders, gets more people on the breakout there. Make sure it gets the stops for anyone who is short above this resistance zone. And then price instantly reverses, strong candle back below the zone. Notice again, it closes below the zone. You want to see this really strong candle creates that false break signal. And also notice what I said about it often retests the area and uses it as resistance again. So price pushes down, corrective pullback, just sort of like touches the bottom of that zone again before holding it as resistance, and then impulsively pushes away. So again, we're using this sort of micro impulsive corrective price action. Everything goes back to that. But we're using it around these zones. So once we've established a strong zone of resistance, we can set our alerts in this area. We can wait to see this type of price action, and then we can start looking to short. Okay. Again, if this market had broken, pushed higher, corrective pullback, we can use this as a zone of support in a more sort of like a true breakout style. But when we see this price action, we are going to wait for the market to communicate to us what it wants to do around that zone, and only then do we actually look to execute and try and get into the market. Too many retail traders, too many traders fail because they want to get in here. Okay, they want to get in on a breakout here, or they don't wait for the market to really tell them exactly what it's trying to do. So by exercising that patience, we can actually think, okay, and this is a good way of thinking things. I always say it's a good way of thinking things as a trader. If this happens, then I will do this. So think, rather than just going, right, it's breaking out, I need to get in. So it's like, okay, well, if the market breaks out cleanly and if it then correctively pulls back to the zone, then I am going to get in to look for a true breakout. But if the market moves into that area and then if the market rejects it quickly, then I am going to be looking for a false break setup. So it's very much trying to get into that mindset. Got some questions here. Okay, great. Thank you very much. Yeah, I mean that's a bearish candle. You want to see, and again, just by definition of it rejecting the market quickly or rejecting that area quickly, it is going to produce a bearish candle of some sort. It can be a bearish pin bar, it could be a bearish engulfing bar. It's going to produce a fairly strong bearish candle around resistance, or it's going to provide a fairly strong bullish candle if it's sort of like a liquidity grab at support. Okay, so moving on to the next bit, we're going to now look at two reversal strategies. Okay, so rather than just looking for liquidity grabs, we're going to look at what you can do to use to look for your reversal strategies in the real market environment. So we're going to look at two. One's called the Bolly reversal, and one's called the 1, 2, 3 reversal. That's my names for them. And this first one we're going to look at is the Bolly reversal, and this one is best for identifying those liquidity grabs. Okay, so the Bolly reversal is a trade setup that can be used when looking for entries at zones of support or resistance. It is generally considered a mean reversion strategy. Okay, we can use this as an entry technique in range-bound markets when looking for liquidity grabs, and also when looking at retests of areas that have broken out. So we can use this in for trend trading as well, once we get the strong breakout and we're looking for retest. But generally speaking, it's best used in corrective phases, and we can use it for identifying those liquidity grabs. The only real indicator that you need is the standard Bollinger Band with standard settings of 22. It will have a mid-Bolly band as well. So you have the upper band, the lower band, and a mid band. And the mid band it's not exactly the 20 moving average, but it's very, very similar to a 20 moving average. Okay. So the Bolly reversal buy setup. Okay, so what we need to do, and we are going to look at examples of this. We need to see price extend outside. For a buy, we want to see price extend outside the lower end of the Bollinger Band. Okay, once we have seen this, we start to look for our signal candle. We don't just enter just because price is extended. We use that as a sort of like a trigger to start looking for a signal candle. If the next candle continues to make a lower low, we continue to wait. You can see price move outside the Bollinger Band and trade, 10, 15, 20 candles outside of the Bollinger Band before it can set up especially in an impulsive move, before it can set up a reversal. So you don't just jump in. You want to wait and exercise that patience. Continue to wait for the signal candle. A signal candle would be any bullish type of candle, a pin bar, engulfing bar, etc., etc. So once we have our signal candle, we enter on a break above that candle. So we've got the push down below the Bollinger Bands. We've now got a bullish candle to represent some buying, and we want to see that candle break. And so we enter a buy stop order just above that candle. Now, what that is will depend on how much above that candle depends on what asset class you're trading, what the spread is and stuff like that. So on something like Euro dollar, GBP US dollar, it might only be a point, like a pip above the level. On something like the DAX, or it might be 2-3 points. But on something like Euro dollar, New Zealand dollar, you might have to do 4 to 5 points, something like that, 4 or 5 pips. So it depends on the currency or the asset class that you're trading, the instrument you're trading, and the spread on it. So the stop is, we place a stop below the swing low that has been created by that move. And our target, and because this is a mean reversion strategy, the initial target should be back towards the 20 EMA or that mid-Bolly, the mid-Bollinger Band line, which is effectively the same thing. And we can also leave some to target the other side of the Bollinger Band or the next zone of resistance. Okay, so we're looking for an initial target of the mid-Bolly, then to the upper Bollinger Band, or potentially to the next zone of resistance. Okay, and then for the Bolly sell setup, it's exactly the same, but in reverse. Okay, we want to see price extend outside the upper end of the Bollinger Band. Once we've seen that, we start to look for our signal candle. If the next candle makes a higher high, we continue to wait until we see our signal candle, which will be any bearish type of candle. Again, pin bar, engulfing bar, or any sort of bearish type of candlestick pattern candlestick that you want to use. Entry, again, once we have our signal candle, we enter on a break below the candle. Stops are on a break above the swing high that has been created by the move up. And the target, again, back to that mid Bollinger Band area, back to the lower Bollinger Band line, or back to the next area of support. Okay, so it's a very simple strategy. It has clear entry, stop, and target parameters, and you should use it and only trade from the highest probability areas of support and resistance that you identify. And again, you can use it once that move has moved outside into a liquidity area and then reverse, you get that engulfing bearish candle or something like that. You can really, like, those are really powerful, strong signals, and really powerful, strong strategy to take advantage of those signals, of those liquidity grabs as well. You can use other indicators such as stochastic, RSI, and volume to support your trading ideas. I personally don't, but I think they're valid. So, you know, if you're looking for sell, then you want your stochastic to be above 80, RSI to be above 70 and turning over, or maybe, you know, you see a shift in the volume to support the sellers coming in. That would be another thing to add weight to your strategy. But personally, just on a very basic level, you can just use the Bollinger Band reversals, wait for those liquidity areas to be touched by the price, and then look to take advantage of the reversal. So this is a US dollar CAD 1 hour chart. We've identified a zone of resistance that we want to trade from. So price extends. You can see price extends outside the Bollinger Band here first. Now, and again, okay, so this is quite an important thing as well to identify. So you can see here, price comes up over here. Okay, price extends outside the Bollinger Band. Price continues further, sets up a bearish candle, doesn't break below, moves higher. Then we get our bearish candle. Like a lot of people, if they trade this strategy on their own, they get in here and they take a losing trade because they take a break of that candle. We only trade from areas of support or resistance that we have identified, because this is what gives us the edge. This is what gives us the highest probability. So rather than taking a losing trade here, we wait for price to continue up, breaks the Bollinger Band here in this candle. So we're looking for our signal candle. Again, pushes higher, takes out the highs, bit of a liquidity grab, and then puts in a bearish candle, closing back inside the zone of support. And then we can enter on the below there. So let's have a look at what our entries would look like. So this green line is our entry, which is at 137.85. Our stop is above the highs that is created, which is this blue line here, which is 13800. So we have a stop of 15 pips. Okay. Now our first target is back towards this mid Bollinger Band, which is this middle line here, which is again effectively the same as a 20 moving average. You can use a 20 moving average if you wish, but the mid Bollinger Band is about the same. This is at 137.60. So we've booked 25 pips of profit there before it moves down back to the next edge of the Bollinger Band, the lower Bollinger Band, which is at 137.28. So our first target has 25 points reward for 15 points stop, or 15 points worth of risk. So we've got a 1.66 risk to reward on that first part of our trade for our first target. And our second target has 57 points of reward for that 15 points of risk, which is nearly a 4 risk to reward trade. So you can see on the second part of our trade, we get much more. So this is, again, one way of allowing us to take advantage and try and maximize some profits. You go for a small target to start with because you're in that range bound market, and then you leave the rest to go for the higher target. It's still going to be just like a 3 to 4. If you don't have, and sometimes this can happen, and this is important to understand as well, if the distance between your entry and the moving average, or the mid volley, or the distance between your entry and the other side of the Bollinger Band is not at least 1-to-1, then you probably want to avoid a trade because you're just taking away the edge. You don't have the statistical advantage or the edge to be able to profit from that. So is that clear to everyone, how you trade? It's a very simple strategy that we can use to use. John, yeah, the Bollinger Band indicator settings, just the standard settings, 22 settings. Okay, they're absolutely fine for that, for this strategy. So just the standard Bollinger Band settings of 22. Okay. Okay. Now moving on to the 1, 2, 3 reversal. Okay, so this is a simple but powerful reversal setup that identifies turning points in trends. Okay, so it is still a reversal strategy, but it's sometimes also known as, I've heard it called like 3 black crows or the 3 white soldiers. And it's a pure price action candlestick pattern strategy. It should only be used in complements, again, with our zones of support and resistance, because those are the areas, again, I think I mentioned this several times before, but I always like to stress the point. The strategy itself is not what moves the market, okay? The market moves because of institutional order flow. So once we've identified the areas where the institutions are trading through our zones of support and resistance, we then look to our strategies for entry, okay? It's not the other way around. As I just showed you with that Bolly reversal, you don't just look for a Bolly reversal and expect the market to move. You look for the Bolly reversal or the 1, 2, 3 reversal from the area of support and resistance you've identified, because those are the high probability areas to move, that market's going to move from. It should only be used in confluence of zone of support and resistance, and we use a lower time frame chart for our execution of the strategy. And again, this is important. We identify the area on a higher time frame, but we want to move down to a lower time frame for our execution. The reason being, and you'll understand this once we get into the strategy, is that if we do it on the time frame that we identified as support and resistance, the market could move too far away for us to get in and not make sense, and it doesn't make sense on a risk to reward basis. So let's go and have a look at this. So a 1, 2, 3 buy setup, or sometimes it's called 3 white soldiers, is we need price to extend into a zone of support. Once price has made a low, we want to see 3 consecutive candles make a higher high and also a higher low. Okay, this represents strong and sustained buying pressure. The stronger the candles, the better. We therefore preferably want to see candles close towards their highs, and you can combine with other technical indicators to add confidence. Again, personally, I don't think you need to, but if you wanted to use sort of RSI, again, looking at that RSI or the stochastic turning round, or like a MACD crossover, or volume, seeing that volume stepping in. Again, volume's quite a good one, especially on sort of stocks. If you're stock trading, volume can be a very clear indicator for that. Then I think it's worth looking at. And again, looking at a 1, 2, 3. Sorry, this is, excuse me. I've got 1, 2, 3 buy setup. This is a 1, 2, 3 sell setup. Typo there on my mistake. Apologies. And this is sometimes known as a 3 black crows. So again, we need price to extend into the zone of resistance. Once price has made a high, we want to see 3 consecutive candles making lower lows and also lower highs. And that's because this represents strong and sustained selling pressure. The weaker the candles, the better. So therefore, preferably want to see the candles close towards their lows. And again, you can combine with other indicators if you wish. Caritza, in TradingView, can I set an alert when price goes outside the Bollinger Band? Yes, you can. You need the Bollinger Band placed onto the chart, but yes, you can definitely do that. The only thing I would sit there and say again is, if you just set an alert for price to alert you when it leaves the Bollinger Band, you're going to be getting alerts all the time. So what I would actually advise is, once you've identified the area of support resistance you want it to trade from, you set an alert for that area, or you set an alert for price approaching that area. And then once you get into that area, then you set the alert for the Bollinger Band. So that's what I would advise. Otherwise, you're just going to get overwhelmed with alerts all the time, because price often pierces the Bollinger Band. Okay. So entry on a 1, 2, 3 reversal. There's 2 options. Okay. An aggressive entry can be on the 3rd candle, making the 3rd higher high or lower low. So you have 2 candles, and then you that have established themselves, and then you enter on a break of those 2 candles. But a more conservative entry is to wait for the break of that 3rd candle. So wait for the 3rd candle to, because basically the 1, 2, 3 is established by the break of by the 3rd candle making the higher high or the lower low. So effectively, that is the start of that is the pattern established, and that's why it's an aggressive entry that you can do to get in there. Or you can wait for it to confirm, finish, set up the candle, and then you look to get in, which is a more conservative entry, because you could get a lower low, but then the price reverses and ends up closing on its highs or something like that. So one's aggressive, one's more conservative, one's waits for the price action to establish and confirm itself more. And again, this just affects your risk to reward. It affects how aggressive you want to be on a trade. If you're going to be more aggressive, you're going to get better risk to reward, maybe but you're also going to take a few more losses. Whereas a conservative, you're going to get maybe a lower risk to reward, but maybe a higher win rate. Target, you want to look to your zones of support and resistance to identify your targets, and your target should be at least 1-to-1 risk to reward away from your entry. And again, this is why we look for the lower time frame to execute rather than the time frame that we establish as support and resistance, because often the market can move too far that we don't have the right risk to reward on our trade on it. So Siyanto, sorry if I pronounced that wrong, but what is the recommended time frame to determine support and resistance? You can determine the support and resistance on any time frame depending on your style of trading. So I personally generally look at 1 hour and 4 hour charts to establish my areas of support and resistance, mainly 1 hour. But you can look at 5 minute, you can look at 15 minute. It just depends on what your time frame is that you're trading. What style of trader are you? If you're going to be a swing trader, you're going to be looking at sort of like those daily time frames. But if you want to be a day trader, you're probably going to be looking at sort of 5 minute, 15 minute, 1 hour, 1 hour and below, basically. So it works on all time frames. It works on all instruments and all asset classes. It's just working out what style of trader you are, what time frame you want to trade on, which suits your trader profile best, and that's okay. Okay, thanks. And yes, you can see that the events team have put this the recording for the support and resistance zone now. Okay, so Lisa, I will cover that in a second. So that's a really good question, and I will cover that in a minute. So we've covered that, right? Okay, so basically what you want to do, and I think I covered this in a previous session where I said, and again, it's just a rough guide. Okay, it's not set in stone sort of thing, but it's a rough guide. If you're this example that we're going to use is one that I'm going to get into this trade that I took, so it's easy for me to use. I identified an area of support on a 1 hour chart. I'm then going to move down to a 5 minute chart for execution. So again, think of it like that. Okay, so if your chart is on a 4 hour, if your support resistance is on a 4 hour, you want to move down to like maybe an hour, maybe a 15 minute time frame to look for execution. If your support and resistance is on daily, you're going to be moving down to sort of like maybe the hourly time frame to look for the 1, 2, 3, and that sort of thing. You want to move down 1 to 2 time frames to establish your execution on it. Okay. Again, it's not a hard and fast rule. But again, just if you're just thinking about it from a perception point of view, you want to allow the market to show that there's some sustained pressure from the other side, but not to move so far away from your support zone that you've lost your risk to reward and your edge. Okay. So this is the example that we're going to use, which is on a euro dollar 1 hour. Okay. So we can identify, we've identified an area of support, which is broken down here. Okay, so we want to enter on a short of this retest zone. Okay, and again, I mean, just going back to the Bolly reversal and everything like that. What have we got here? We've got a clear zone of support. Okay, what does it do? It takes out the lows, puts in a reversal. You get out at the mid Bollinger Band for some of your first target. Doesn't quite reach the upper body. In fact, it would do over here. This is where your second part of your trade would come out, because it wouldn't have stopped you out. But again, you see that liquidity grab, you see that Bolly reversal, you have a trade opportunity there. I didn't even look at this one when I did this example, but you can see the other stuff playing out on the charts all the time. But for this, we've seen price breakdown on the euro dollar 1 hour chart. We can see price starting to be corrective, so we want to look for a short, a sell on the retest of this zone. Okay, because we've got broken support, impulsive move, corrective pullback. We therefore want to look for this as resistance. Okay. So we switch to a 5-minute time frame on the euro dollar, and I've used this example on purpose because I wanted to just show the characteristics, and because a lot of people can jump in to a trade incorrectly on this. So we've got option 1, what price moves in, pushes away. We've got option 2, pushes away, and option 3, pushes away. Only option 3 is valid. Okay. And the reason being, if you see here, okay, price makes its high. This second candle here doesn't make a low. Can you see it doesn't break that low? So even though the next candle does, you don't get that 1, 2, 3. You don't get the second candle making its lower low. So therefore, that as soon as you see that signal becomes completely invalid. You can't trade. You've got to wait again. And again, price makes a higher high, the highest high, but it doesn't make the lower low in that candle. Okay, it doesn't break this candle's low. Oh, excuse me, it doesn't break this candle's low, so therefore it's invalid. And because this one wasn't the highest high, this one doesn't become valid. Okay, this one is valid because it makes the highest high. Next candle, lower low. Next candle, lower low. All three lower highs, lower lows, closing on their lows. Therefore, we've got a really good setup. Also, can anyone just tell me what they see from this as well? What do we get from that third pattern? Anyone identify what we can see from that third pattern as well, which gives it a much more powerful signal with what we've been speaking about today? Yep, Denise, it bounces back quickly. That's one of the things. Yes, I didn't even spot that, but it does. It breaks down and retests that zone of uses as resistance there. So Leon, FVG, I'm guessing you mean fair value gap or something like that. But this is it's basically a liquidity grab. It moves back above. It moves back above the area, above that resistance, and then rejects it quickly. So it's a liquidity grab. It's a reversal pattern. You know, it moves back impulsively. It ticks again a lot of those boxes that we have been speaking about. And again, this is actually a Bolly reversal. You know, you moved above the Bolly, up there. This first candle is actually a Bolly reversal as well. So again, just showing you how all of these things sort of tie in. But by adding all of these confluences in and looking at these finer details, that's when you get the best setups rather than trying to chase them in sort of like setups like this. Like 1 and 2. So is that clear to everyone? You look for these 1, 2, 3 pattern. Your entry, your aggressive entry is a break of this second candle, which is at 116.58, or your conservative entry is on the break of that third candle once the reversal is fully established at 116.53. Your stop needs to be above the highs, which is created at 116.73, and your target is back to the next zone. The next zone I had down here, which you can see a swing high, resistance, low. So that is the area that I target, which is 116.33. So just again, an aggressive entry has a 25-point reward for 15 points of risk, so 1.66 risk to reward. And the other entry has 20 points reward for 20 points risk, which meets our minimum requirements of a 1-to-1 risk to reward to get that. So and that's it. That's the question. That's the presentation. We've got about 10 minutes, guys, for any questions, for any Q&A. So I think we've covered all of the questions so far. If I haven't, then please do feel free to post them back in. I do apologize if I have. It hasn't been intentional. But if I have missed a question, please do fire it back in. If not, please fire away with any questions you've got. Other than that, you've got here, you can see how you can sign up to a live account with VT Markets. And once again, please do stay on and give us some feedback on that survey afterwards, because it will really help us. It helps us to tailor this content to make sure you guys are getting exactly what you want from this series. And yeah, you know, please also register for the next session. We're going to have another live trading session as well in September, and that one we are going to make that 90 minutes as well. I know from the request, from the feedback, a lot of you guys have asked for the sessions to be a little bit longer. So for the live trading session in September, we are going to make it 90 minutes as well. We have got another. Yeah, I know it's quite far away, Denise, but we have got another session in a couple of weeks' time. We're going to be talking about trade plans, trade journaling, like really focusing on. It's a basic principle of trading, but it's something that is essential, and a lot of people overlook it. But also a lot of people I find overcomplicate the process. So we're going to really look at what you need to have in your trade plan, what you should be journaling, and then also how to analyze this and update your trade plans and stuff as well. Okay. Okay, a couple of, so Joanne saying later in time. We can certainly speak about that, but if not, obviously these sessions are recorded. Joanne, so if not, you should be able to follow the replays as well and get the value. And then obviously you have it, if you have any further questions about it, please do feel free to reach out to us, and we'd be more than happy to answer questions. And there's a link in there from the events team where you can subscribe to the newsletter and also get updates about the webinars and the upcoming webinars and stuff like that as well. And also for the Telegram channel to get the market updates. So there's a lot of information there that you guys can get to really help cement this learning, cement the course, and sort of like support the information from this course as well. Ketu, yes, unfortunately the session is just coming to a close, but again, you can watch it on replay, and then if you have any questions, please do feel free to reach out to us, but please also register for the next session in a couple of weeks' time. It's, like I say, it's not one that a lot of people put a lot of emphasis on, but it is vitally important to get those foundations right in trading. So I really do suggest you you come along to that one as well. So Sahid, if you join the Telegram channel, there are daily market updates, which provides analysis and stuff, I believe. Cool. Okay, guys, well, there's no other questions coming through. So I hope you found that useful. We've covered now sort of trend trading strategies, reversal strategies. So I hope you've got some ideas there that you can actually go and take them into the markets as well. And I hope you understand as well the really big thing is having a bit of a mindset shift around these liquidity grabs. Rather than falling victim to them, we can actually use these strategies and the characteristics to actually profit from them and take advantage. So wishing you all the best in your trading, and I look forward to speaking to you